Today we're going to talk about how to get started investing in the stock market and the path to buying your first share. So what actually is the stock market and why do people invest there? A stock market is a place where you can buy and sell shares in publicly traded companies. Just like any other market, whether it be a supermarket or an online marketplace for electronics. They are operated all over the world and run through organisations called stock exchanges. Some of these you may have heard of, such as the New York Stock Exchange, the London Stock Exchange, the Hong Kong Stock Exchange, and the Shanghai Stock Exchange. So what exactly is a share? A share represents a proportion of ownership of a company or asset. A publicly traded company is a company that anyone in the public can buy shares in. Each company will have a different amount of shares that are available for purchase. This will equate to the certain percentage ownership of the company. For example, buying a share in Apple gives you part ownership of Apple. Companies have unique identifiers on the stock market called tickers. If we look at the Apple example, their ticker is AAPL. So how much should you pay for a share and what dictates the price? A share's value is not necessarily the price at that moment in time. Just like you can think a pair of shoes are overpriced, the same can be said for shares. The price is based on supply and demand. If more people want to buy the shoes than there are people selling, the price will rise. That is the very basics of a free market economy. This means there is no single way to derive what you should pay for a share. The most common way to decide if the price of a share is worth paying is by looking at the value and quality of the company behind the share. This can be quite complicated and there are many ways to achieve a perceived value, but one of the most common and basic measures is the price earnings ratio and the price book ratio of a company. We will look at these two measures in more depth in a later video. Because of free markets, no one person decides what the ongoing price of a share should be. This is why shares can climb quickly and also drop quickly. Just like you wouldn't spend £500 or dollars on a loaf of bread, you need to be aware of the price you are paying for a share based on the underlying value of the company. So now you have a basic understanding of what a share is. How do you decide which shares to buy? So it might not sound too complicated and you might fancy yourself as the next Warren Buffett, but choosing individual shares to buy is hard work and if done correctly should be very time consuming. You have to remember that by buying a share in a company, you should try and find out as much as you can about that company before you buy. For example, you probably wouldn't buy a second-hand car without knowing anything about it. The same should be said for buying shares. This means doing research on the company you are thinking of buying, looking at their financial history and what their plans are for the future. You also have to consider your risk position. As much as you hope for your shares to rise in value, they can also drop. This is where we can take action to reduce our risk, called diversification. Diversification is the process of owning assets that don't all behave in the same way. If all your money is in one or two companies and they fail, you can risk losing a lot of money. There are many different ways you can diversify, from buying different assets or shares in different industries. In a later video, we will look more closely at the different ways to diversify your investments. This brings us to the concept of buying the market. The founder of Vanguard, Jack Bogle, came up with the famous quote, "Don't look for the needle, buy the haystack." What does he mean by this? Essentially, it means rather than trying to find individual stocks that you think will do well over time, just buy a whole collection of shares in different companies. This may sound like a lot, but has been made very easy by the financial world. One of the great benefits of buying the market is that you get exposure to lots of different companies, which helps you diversify and reduce your risk. So how do you go about doing this? One of the most common and popular ways to do this is buying the S&P 500, which is an index that tracks the 500 biggest companies in the United States. The best way to buy the S&P 500 is via an ETF. An ETF is an exchange-traded fund. Essentially, a big financial company, such as BlackRock or Vanguard, will buy the individual shares of companies in the S&P 500. They will then package all these shares together in an ETF. As an individual investor, you can buy a share of an ETF. You are buying a slice of a very big cake. There are lots of different ETFs for all sorts of asset class, from government bonds to shares, and they focus on different areas of the market, from medical innovation to green technology. There are small charges to be aware of with ETFs, and all this information can be found in the Key Investor Information document online. An example of an S&P 500 ETF would be the Vanguard S&P 500 fund with the ticker symbol of VUSA. Now we have spoken about the different types of shares you can buy, let's look at how you can actually buy the shares. You have to buy shares through a share dealing broker. There are many brokers to choose from, so it is important to do your research to see what the costs are to trade with that broker. A good place to start would be Trading 212 or Free Trade. Both offer commission-free trading. The way they make their money is the spread in price between buying and selling a share. Once you have decided on a broker, you then need to decide what account to use. For most UK individual investors, it would be most sensible to use a stocks and shares ISA account. This will allow you to transfer in £20,000 per year, and any money you make from your shares will be exempt from tax. Each broker should have clear instructions on how to open an account and place a trade using their platform. Now you have a basic understanding of how to buy your first share. Let's now look at how you can make money from investing in the stock market. For the individual investor, there are a couple of ways you can make money from shares. The main way is through the price increasing. You buy a share with the plan that it will go up in price at a point in the future when you might want to sell. Investing in shares should be viewed as a long game, and on average, you should plan on holding a share for at least 5 years. If you cannot leave the money invested for 5 years, you should ask the question, is this the right time for me to be investing? Another way to make money is via dividends. A dividend is a payment a company makes to shareholders from the company's profits. Not all companies pay dividends, and there is no obligation to pay them. This is something you should bear in mind and research and decide before you invest. So, the key points to take away for your first time buying shares. 1. There is always a risk you will lose money. 2. Picking individual stocks is hard work and should be time consuming. If you don't have the time to commit to researching companies, you're probably better off buying into an index fund via an ETF such as the S&P 500, the FTSE 100, or an all-world stock index. Thanks for watching, and if you have any questions, please leave them in the comments below. Stay tuned for more videos about different finance topics.